Today we're going to be talking about our the newest Four Oaks Capital investment offering, Live Florence Apartments in Florence, South Carolina. Florence is the fifth largest MSA in South Carolina. Population 225,000, growing, expected to grow to about 250,000 in the next couple of years. Some phenomenal job growth. The home of the newest inland port in South Carolina. One of the reasons that we've loved the upstate of South Carolina, where we have 5 of our current assets, is because of the inland port up in that neck of the woods. And they opened the newest inland port, which we'll talk about here in a little bit, up in the Florence area about 2 years ago now. And it just continues to grow and thrive with a ton of new industry coming that way. And we'll touch on all of that. But in just how we start all these things, thank you for joining us. I'm going to run through kind of a high level of the investor packet. We're going to run through the underwriting in a little more granular detail, answer any questions you guys have. We do have the chat function. So if you want to ask any questions, Brian Briscoe and Brian Mallon will be in the chat box to be able to help answer questions as we go. And then anything that's remaining at the end, I can certainly do. For those of you that do not know me, my name is Eric Shirley, and I am the Director of Acquisitions here at Four Oaks Capital. Myself and my team, we are responsible for finding all of the opportunities that Four Oaks is able to bring to our investor public, as well as doing the underwriting, doing the due diligence, pretty much everything that's involved in the deal all the way until we close. So with that said, let's go ahead and dive into this opportunity, Live Florence Apartments. So we start off legal mumbo jumbo. This is an investment. With any investment, there is a level of risk. Our goal tonight is to walk you through this investment with a great level of detail and answer any questions that you might have so that you feel like you can make the best option as far as your investment opportunities. So Live Florence is a 144 unit townhouse apartment complex. There are 16 1-bedroom, 1-baths, 72 2-bedroom, 1-baths, 48 3-bedroom, 2-baths, and 8 4-bedroom, 3-baths. We're super excited about this opportunity. We feel like we found a diamond in the rough. As most of you, I'm sure, have seen in this competitive landscape, it is tough to find good opportunities right now. We've been going through anywhere between 150 and 200 deals a month trying to find our next opportunity since the year started. We've submitted about 6 LOIs, and this is the first opportunity that we've really been able to capitalize on and be competitive in, get at a price point that we're really, really excited about, and be able to bring this offering to you, our investor base. So we have this under contract for $8 million. The total capital raise on this one is just around $3 million, of which 1.3 million of that is CapEx. We got some really exciting loan terms that we'll touch on here in a little bit. But 2 years interest only, 3.7% interest, 80% loan to cost. So not only are we able to finance 80% of our purchase price, but 80% of our CapEx as well, which is really exciting. Most of the deals that you see, I'm sure, go 5, 6, 7 year holds. Well, we are really trying to ensure that we can have phenomenal returns for you, the investor, and return your capital as quickly as possible. And this deal really allows us to do that in a hyper-focused way. So this is a 3-year hold, projected hold. And we'll walk through kind of the strategy behind that in a few minutes. But in that 3-year hold, we have a 17.4% average annual return, a 16.1% IRR, and a 1.53 equity multiplier in those 3 years. So we're really excited to be able to generate really strong returns, hold your capital for a very short amount of time, and then return that capital with the proceeds and allow you to reinvest your capital in the next opportunity. Minimum investment is $50,000, maximum is $600,000. We have a very long wait list for this one, so we expect it to fill up quickly. Our last deal filled up in about 48 hours. We don't expect this to be any different. So let's talk really fast for those of you that don't know us. This is our Four Oaks team. As I mentioned earlier, myself and my team head up our acquisitions. We're responsible for finding these deals and kind of bringing them to the table. Todd Butler, our Director of Asset Management, Kranti Panam, our Director of Capital, Brian Briscoe, Director of Marketing, and Brian's going to be launching our educational platform as well as our networking platform, Tribe of Titans, coming up here in the next couple months. So keep an eye out for that. We're really excited about that. Kelsey Bailey. Kelsey was previously our data analyst and she has now migrated into running our cash flow concierge program. Brian Mallon, our director of investor management, and last but not least, many of you guys already know her, Deb Pritchard, she is our CFO. So Florence, South Carolina. Florence is an awesome growing kind of metropolitan in the state of South Carolina. It's got a beautiful historic downtown area, and it's fueled by a variety of things, industry, manufacturing, as well as medical. Florence has one of the largest medical facilities in the state. McLeod Regional Hospital employs about 8,500 people, and McLeod continues to grow and is becoming really, really renowned for being one of the top medical institutions in the state. So that's just one of the many things that Florence has going for it. It's a beautiful downtown area. Like many of the areas that we love to invest in, Florence has pumped a ton of money into revitalizing their downtown area. And they've just done a really nice job. It's a beautiful place to hang out. There's a tremendous amount of job growth going on. And it's just a really beautiful downtown area that they continue to pump money into to make it more and more attractive. Millikan Institute ranked Florence number 4 of the biggest gainers as far as our 2020 best performing cities. And a lot of that is based on the inland port that I had mentioned earlier. I'm going to dive into that in a little more detail in just a second. But there's a lot of job growth happening, a lot of manufacturing moving here. And one of the big reasons for that is kind of around where it's located. For those of you located in the Southeast, you're going to be very familiar with I-95 and I-20. If you're not from the Southeast, I-95 is one of the largest north-south interstates in the country. And I-20 is one of the largest east-west interstates in the country. I-95 runs from Miami and the Keys all the way up into basically all the way up through Maine. I-20 actually starts in Florence and goes all the way over into Texas. So it is a massive corridor for transportation right at that intersection of I-20 and I-95. Because of that, that is why the Port Authority in South Carolina deemed it to be the newest inland port. It is a great little hotbed where manufacturers can post up. There's a ton of cheap labor, ton of cheap land. South Carolina has phenomenal tax incentives for manufacturers to move to it. And it's centrally located right at these transportation hubs. So when goods come in from China into the port cities, the Wilmingtons, the Savannahs, the Jacksonvilles, the Charlestons. Charleston's a huge port city. It's very expensive for them to manufacture and warehouse goods on the coast, as well as the cost of upkeep and the cost of labor. So they're starting to move the manufacturing and warehouse facilities further inland, bring the cargo ships full of the raw materials in via train, and then manufacture whatever the goods are, load them up on a semi, and hit one of these interstates that's going to kind of disperse it throughout the country. So Florence, as I mentioned earlier, Florence's economy is booming. It has a large share of workers concentrated in trade, transportation, utilities, as well as healthcare. Ruiz Foods just announced a $79 million expansion. It's going to bring 700 new jobs. Honda's expanding their current investment in Florence. That's going to generate another 250 jobs. Healthcare, both GE Healthcare and McCall Farms have expansion plans. As I mentioned earlier, McLeod Medical, which continues to grow and boom and become really a major hub. One of the things people don't know about Florence is actually the denture capital of the world. Sexton's Dental manufactures dentures, and Florence makes more dentures than any other place in the world. So just a fun fact there. So let's talk about a little bit about some of the economic drivers, what multifamily is looking like in Florence, and why we like it so much. So over the past 12 months, rent growth has gone up 3.1%, which is really strong. Obviously, we're looking for areas that can continue to have those strong economic drivers and job growth, which is going to help allow push rents as the population grows. Vacancy, on the other hand, continues to go down. Average vacancy in Florence is hovering right around 4%, which is really, really strong. This specific property is as of Friday, was at 98% occupied. Of the 144 units, 142 are inhabitable. 2 of them are currently down and need to be renovated. Basically, they're gutted down to the studs. They've been used as storage for the current maintenance staff, where they're storing things like windows, doors, all their supplies. We're obviously going to bring those 2 units back to rentable condition within the first couple months of ownership. But of those 142 inhabitable units, all 142 are occupied, and there is now a wait list. So that is a phenomenal place to be at that level of occupancy. especially considering that rents are continuing to get pushed in this marketplace. So this isn't kind of a high level look, literally a high level look at the property from drone footage. You can see it's laid out very nicely. The entire property is gated, so there's a fence around the entire property. Back here in this corner is a massive amount of green space that we intend to amenitize. All of the roofs have been redone within the past 5 years. Approximately 80% of the HVAC units have been replaced within the last 5 years. Really, the big CapEx drivers for this property are amenitization, removal. I don't know if you can see in this picture or not, but there's awnings over every single door, both front and back. As I mentioned earlier, all of these units are townhouses, which are in very, very high demand. So we want to remove those awnings and really give it a more modern, clean feel. Property was built in 1972, and those awnings make it feel like that. So remove those awnings. The roofs are in great shape. Parking lot needs to be redone. There's some massive potholes that just aren't repairable. So we need to re-asphalt the entire thing. In addition to that, there is aluminum wiring in this property, and we are aware of that. So we are going to go in and do a pigtail project, basically an aluminum wiring remediation to copper. And that's going to be something that's going to happen within the first 2 to 3 months. We already have quotes on that. And we're going to get in there and get that taken care of very quickly. This building right here, if you can see my mouse, kind of here in this lower quadrant, is the leasing office and laundry facilities. And then there's a dog park right in here, kind of this little green space right in front of the leasing office. So we're going to further amenitize the property, clean up the exteriors, renovate the interiors. Of the 144 units, about 64 of them have already been renovated. When we first put the property under contract, it was 60 units. Now it's up to 64. So we have about 80 units left to renovate. Of those 80, 60 of the 80 are kind of a medium renovation. And then about 20 of them are going to require a little bit heavier of a lift. We're going to need a little more cabinet work, new appliances, just a little more love to bring them up to where we want them to be. You can see here, you can see the awnings. The outside is extremely clean. The siding is in great shape. The roofs are in great shape. The brick is in great shape. We're just really bullish on the quality of this product. Landscaping looks phenomenal. Over here where you see the balloons, that's the leasing office as well as the laundry facility. So as I mentioned earlier, there's 16 one-bedroom, one baths. Those are 725 square feet, 72 two-bedroom, one baths that are 900 square foot, 48 three-bedroom, two baths that are 1,120 square feet, and 8 four-bedroom, three baths that are 1,255 square feet. So really nice size units. Again, they're all townhouses. So they're really spacious townhouse units that are proving to be in very high demand with current occupancy level. As I mentioned earlier, when we first put the project under contract, 60 of the 144 units were renovated. Now it's up to 64 of those 144 units. The roofs have all actually been replaced within the last 5 years, as well as 80% of the HVACs, which I mentioned earlier. As far as current on-site amenities, there is a dog park on site. There is a laundry facility in the rental office, but we do want to add in a playground. This is a family-friendly apartment complex. There's a ton of kids here, and we really want to give the kids a great, safe, fun space to play. So that's one of our top priorities, is to add the playground. There's a ton of upside due to the in-place rents, which are well below market rates, and I'll touch on those in a few minutes. In addition, occupancy is currently at 98%, which is huge. If you've invested with Four Oaks before or seen some of our webinars, we're usually looking for heavier lift product. To be able to find this product at a competitive price point, that $8 million works out to be $55,000 a door, which in today's marketplace is really, really a great price point to come in and be able to it's a great starting point with price point. Most of the C-class assets in the top 5 major metros in South Carolina, 70s vintage C-class assets are now trading between $80,000 and $95,000 a door. I'll give you a great example. Columbia, South Carolina. 18 months ago, C-class 70s vintage C-class assets were trading somewhere in the $60,000 to $70,000 a door range. Now they're trading literally in the $85,000 to $95,000 a door in just 18 months. Cap rates continue to compress, prices continue to go up. So to be able to find a great high occupancy asset with room to push rents at $55,000 a door and kind of a very light lift comparatively, We're really, really excited about this opportunity. We have great favorable lending terms from Greenville Federal Credit Union. It's 2 years of IO, 80% loan to cost, which is great, at 3.7%. No reserves required. So unlike agency debt, Fannie and Freddie, where we would have to put reserves down, we don't have to worry about on this property. And we're getting really, really attractive loan terms. Money's cheap right now, and that's another thing really driving multifamily investments. As we mentioned earlier, the property is really situated in a great location. It's about 1.2 miles away from kind of that central historic Florence area. And it's about 1 mile away from McLeod Medical Center, which I mentioned earlier, is one of the largest hospital systems in the state, as a huge driver for employment kind of in this area. It's also located right up the road from the inland port, which is, as I mentioned earlier, is capitalizing on the intersection of I-20 and I-95. So this is a picture of the current renovated units. As you can see, the cabinets are in great shape, look clean. We are going to be doing black appliances when we go in, LVP flooring, and we'll touch a little bit more on the CapEx budget, but you can see the units look great. The renovations that the current ownership group have done have been fantastic. One of the things that we really like about this ownership group is they continue to improve the property even though it's under contract. They had 4 pre-leased units that they went ahead and did the renovations on so that they could go ahead and get those tenants in and get them moved in and settled. And that was something that they didn't have to do. They did that on their dime. And that's just kind of a testament to the level of work that this ownership group is doing and the level of renovations they've done with this property. They've really turned it around phenomenally. So let's look at the floor plans. These are the 1-bedroom units. It's you walk in, you've got the bedroom, bathroom, a nice galley style kitchen, living room, den. Again, these are 725 square feet and there's 16 of them. 2-bedroom units. These are 2-story townhouses. So you walk into the living room, dining room area, get a nice sized kitchen and pantry, the stairs, 2 very nice sized bedrooms, and then a shared bathroom upstairs. Those are 900 square foot units, the 2-bedroom, 1 baths. The 3-bedroom units have a very similar layout downstairs. They do have a half bath downstairs, as well as 3 large bedrooms upstairs and a shared bath. Those are 1,120 square feet, and there's 48 of them. And then the 4 threes, again, very similarly laid out on the downstairs. 2 full baths in the 2 full, these are 4 twos, 2 full baths, and then 4 nice sized bedrooms. Those are 1,255 square feet, and there's 8 of those. So let's talk about our business plan and what our intentions are with this property. Because of the amount of the renovations that have already been done in the first 64 units, we're really going to come in and mimic the improvements that the current ownership group has already started. So our plan is to provide basic upgrades to both the interiors and the exteriors. We're going to improve curb appeal, and we're really going to cater to the current tenant base and rely on the referrals. And that's how they've really had such a high level of occupancy, is through word of mouth and referrals. Traditionally, we spread our interior renovations over a 3-year period. This will be no different. We will do our renovations on turns. So as folks move out, we'll improve the units, renovate those vacant units, offer those vacant units once they're renovated to the current tenant base that is in an unrenovated unit. And then once we run out of tenants that want to be upgraded, we will transition into kind of focusing on new tenant bases. Maintaining a high level of occupancy here is paramount. As I said earlier, it's currently at 98% occupied, and we would really like to keep it at that very high level of occupancy. You'll see we've been very, very conservative, as we always are, in our vacancy. And I think you'll see how, while we've been very conservative in our underwriting, we should absolutely knock the cover off the ball based on the current performance and what we intend to do with the property over the next 3 years. Our property management company. So for those of you that have invested with 4 Oaks in the past, we have made a property management change. We did that about 2 months ago now. And one of the reasons we did that was we were at a place with the number of units that we had kind of under our belt where we could bring in a higher caliber of property management and take advantage of the size of our portfolio and really be competitive with pricing. So we've switched our management over to Fickling Property Management Company. They're based out of Macon, Georgia, and they're absolutely top notch in everything that they do. If you look at their entire portfolio, they're up to right around 3,000 doors now. They're averaging 95% occupancy across their entire portfolio, which is phenomenal. The reporting is second to none. They have a phenomenal in-house accounting team. Their on-site staff is really impressive, and the reporting is top-notch, which is really going to allow us to further our reporting when we send out our investor updates on a monthly and quarterly basis. So we're really excited about the transition to Fickling. And Fickling was a huge part of our due diligence process that occurred about 3 weeks ago now. And here's what Kristen Sanders, the VP of Fickling Management Services, had to say. She is extremely hands-on in the due diligence process. We had a crew of 4 folks from Fickling that were on site with us, with Todd and I, and they were very, very involved in the due diligence process. And not only was Kristen impressed with the cleanliness and the upkeep that the properties had up to this point, but she saw the opportunity that we saw, not only by renovating units, increasing rents, and adding these additions that we've talked about. We're going to be really focused on creating a sense of community within the property. And we think that that's just going to push it over the edge. In addition, we're going to do some rebranding and some phenomenal marketing, some of the unique features and improvements that we're going to, that not only Florence is going through, but that we're going to do within this specific property. And between the Four Oaks vision and the Fickling execution, I have no doubt we're going to absolutely knock the cover off the ball. So let's look at that CapEx budget, what we intend to do with it, and kind of a more granular breakdown of where those monies are going to go. So we have a $1.3 million budget. In the interiors, we're going to continue the current theme with LVP flooring throughout with kind of that driftwood grayish look. We're going to paint the interiors, renovate the kitchens with cinch kits. For those of you that have invested with us before, you know we love that cinch kit product. It really makes the kitchen pop, look modern, clean, and fresh. New cabinet hardware, new appliances were needed, upgraded and updated LED lighting packages, new sinks, and low flow faucets. We're going to continue to renovate bathrooms with new vanities, reseal the tubs and reglaze the tubs so they look really, really nice. And again, add in low flow toilets and sinks. We are going to remediate the current wiring so that we can kind of bring down our insurance burden. And that is going to happen very, very quickly upon taking this property over. On the exteriors, we're going to remove the awnings. One of the nice things with the current awnings is they are not built, they are screwed into the brick, but the structure of the awnings is not built into the brick. So it's literally just a matter of unbolting the awnings. I'm cleaning some of the overspray from the paint where they've been painted in the past. And it's going to give it a clean, fresh, modern look. Repaving the parking lot. There are some massive potholes. I have an SUV and it about fell in one. So repaving the parking lot is something that's going to be very important. The group that we have coming up to repave the parking lot is actually out of Florida. And they they actually came in and gave us a quote that was about $60,000 less than the local paving companies. And this company works throughout the Southeast. They have a great reputation. And this will be the first time that we're going to be able to utilize them. But we're very excited about that. Pressure washing the current brick exterior, replacing some of the windows as needed. In the past, as the glass panes would be broken, instead of replacing them with glass, or not the current ownership group, but the group prior had replaced some of that glass with plexiglass. We don't like that. It's not energy efficient. So we will replace windows where needed. Update the landscaping and improve the curb appeal. Rebrand the property and improve the signage, and we'll show you a picture of what that looks like based on what we've done with some of our other properties. And then install a playground to really kind of tie out the amenities and make it a true family-friendly asset. These are just some examples of some of the previous renovations that we've done. You can see we love that LVP flooring. We love the faux granite countertops with the shaker doors. And it really just gives it a clean, crisp, modern feel, despite the fact it's a 70s vintage product. It's going to make it look a lot more modern and a lot more updated. So let's talk about the rebranding. We will rebrand this property. It's currently called Live Florence. We will change that. We do not have a name in place yet, but this is a look at our Clemson property, which was called, it was Heatherwood Apartments. We rebranded that to 100 Regency at Clemson Townhomes. This is the sign that we went with. All of this is acrylic lettering with backlit lighting on kind of a fiber cement wooden faux wood cabinet, and it's going to look absolutely incredible. And these are the types of things we're doing to try to take some of these older vintage properties and give them that modern flair and that modern feel, and really give it a fresh new look and a fresh new vibe. And again, this is just kind of some of the rebranding things that we've done in the past, and we intend to do that here as well. So let's talk about comparative rents, some of the comparables, and why we think that we're going to be able to push rents so aggressively here. So if you look, these are the 17 or 18 apartment complexes that are in kind of that downtown Florence metro right now. We are, the Live Florence Apartments is at 72 cents a square foot. So it is at the very bottom. We're looking to push rents from 605 for the studios, or excuse me, for the one bedrooms, 654 for the twos, 779 for the threes, and it's actually 824 for the fours. We're going to push to 675, 775, 875, and 975. You can see with the current competition, that is right in line with what other people are charging in this market. The next smallest, or excuse me, the next cheapest apartment complex at 75 cents a square is already at 686. We're looking to push to 675 in 3 years. They're at 775 for the twos. We're looking to push to 775 in 3 years. They're at 855 for the threes. We're looking to push to 875 in 3 years. And they don't have fours, but we're looking to push to 975 to the fours. We feel extremely confident with our ability to do that. Current ownership group has started pushing rents, and even with those rent pushes, they're on a wait list currently for new apartments. So our current average rents are at $653, and we're looking to push those average rents about $150 over 3 years to that 808 mark. Within a 3-mile radius, there are numerous Class C properties, which I just showed you, that are very similar comps. All the units are a little bit different in layout and size when we're looking at comparables, but there is no other 100% townhouse product on the market. So the demand is going to be high because you're not going to have neighbors above you or below you. You're really going to have neighbors on the sides of you. So that is an extremely attractive quality that folks look for. And all of our units are townhouse style apartments, which is huge. Again, with our value add strategy, we did some secret shopping during the due diligence period. Our interiors are going to be much nicer than the comparables that we're looking to compare it to. And we're adding amenities that are going to allow us to be competitive with the playground. And as I mentioned earlier, that gives Fickling everything that they need to be able to execute our business plan and push those rents over a 3-year period. In addition, as we talked about earlier, I'll pull this up here. The average annual rent growth in the Florence market was 3.1% over the last 12 months. We are looking, once we stabilize the asset, again, as you guys know, we plateau off at 1.5% average annual rent growth, which is well below the 12% trends. So why we like this investment, we love the fact that the occupancy is currently high. Not only is physical occupancy high, bad debt is less than 5%. It's hovering right around 3% right now. Of that 3% bad debt, 2.2% of that is coming from 5 tenants. Those 5 tenants, they filed for eviction for, and those tenants will be gone by the time that we take over. So we're going to be able to put new tenants in. The current ownership group has agreed to use our criteria, which is a little more stringent, moving forward with placing their new tenants until we take over the property. So we're really excited about the opportunity to take over something that already has such a high level of occupancy. I keep saying 98% occupancy as of last Friday. It's really 100% occupancy with inhabitable units. The 2 down units that they currently have are not inhabitable, but we are counting that towards the full occupancy level. And that's why it's at 98%. Again, comparable properties are getting our 3-year projected rents today with a 96% average occupancy. Guys, that's huge. The fact that our 3-year rent bumps are being achieved with comparable properties today those properties are maintaining a 96% occupancy level. That bodes extremely well for the execution of our business plan. Again, we talked about what we're looking to do with our CapEx budget. Really just kind of continue the current trend on the renovation interiors of the interiors, as well as clean up the exteriors, give it that clean, modern, crisp feel, add some amenities, redo the parking lot, and rebrand. And we really think we're going to have no problem hitting these rent bumps very, very quickly. And before we dive into underwriting, I do want to talk a little bit about this because not everyone is aware of this and we haven't made it public yet, but we have started receiving unsolicited offers for some of our current offerings. We are really excited about this. We've already received an offer for one of our properties. It's 80 units in the upstate. We've only owned that property for 12 months. We've already received an offer that's above our 6-year hold projected exit price. So while we were looking to exit at a certain price point in 6 years, we've already received an unsolicited offer. We're currently in the process of vetting that offer, but we've already received an unsolicited offer for higher than our 6-year hold period in the first 12 months. I tell you that because we are buying right. We are buying the right types of properties. We are buying at the right price points. We are underwriting conservatively, and it's starting to show. So we're doing things the right way, and we're really, really proud of our conservative underwriting and the fact that we can continue to bring these types of offerings to our investors with the level of conservative underwriting that we feel very confident we can stand behind. And we're really going to be able to deliver in a very high level for our investors. So let's talk about the specifics of the underwriting. And actually, I'm going to pull up the actual underwriting document here. So let's take a look at our P&L. So in the first year, we're looking to bump rents from that 653 to 675. That is being hyper conservative. Sharing is paused. Bring your shared window to the front. Brian, can you tell me, can you see my underwriting screen?
I can see it.
You can see the Excel file or the
No, it's the investor packet. I think you might have to make it on full screen.
Okay, I'll just go back and we'll walk through it on the investor packet. That's fine. So year one, we're looking to bump rents about $20 on average. So very minimal rent bumps in the first year. But we are factoring in 15% total vacancy. Again, right now we have 2% physical occupancy. We're factoring in 8% in year one, and we have about 3% bad debt currently, and we're factoring in 7% in year one. So our current, as the property stands right now, is at about 5% total vacancy between physical and economic vacancy. We're factoring in 15% in year two, or excuse me, in year one. In year two, that's going to come down to 12.5%. Again, well above what the current operations are. And then we're going to level off in year three around 10%. Again, we're at 5% right now currently. So we have a ton of cushion built in for kind of any unforeseen things that can happen in the marketplace. Currently, the current ownership group is charging RUBS bill back for water, which is master metered. The electricity is individually metered, so the tenants are paying that. But the water is master metered, so they're billing that back to the tenant base, as well as trash and pest control. We are going to continue that trend. And that's why you see minimal growth over the next 3 years on that. That's just basically growing with inflation. And then same with other income. We've actually reduced that down from the current T12 slightly. And then it's growing just at an organic rate that's below inflation. So we're very confident with those RUBS and other income numbers. You can see the current T12 price per unit annualized out. The current expense burden per unit is right at $3,900 per unit in the T12. In our year one, we're up to right around $4,300 a unit. So we have been much more conservative by right around 10% in the current expense burden, building in some additional cushion. So let's run through that real fast. We're looking at about a $5,000 advertising budget. Fickling does a phenomenal job with leveraging free advertising tools. So through their management software, they're able to advertise on all of the major kind of apartment retailers, if you will, the Zillows, the realtor.com, apartments.com will be leveraging. They take advantage of Facebook Marketplace as well as Craigslist, and they're able to do all those for free. Not only that, they're, as I mentioned earlier, they're at 95% average occupancy across their full portfolio. So what they're doing is working, and we're going to let them continue to do what's working well throughout their portfolio and leverage that here. Contract services, that's our landscaping and pest control. We're keeping that very much in line with the current T12. Those contracts we are going to assume. We're very happy with the current landscaping company, but Fickling is going to shop that around once they take it over and try to get both our landscaping as well as our pest control bought down. But we're going to keep it in place with the current contracts that are existing. Gas and electric, those numbers are the same as the T12. General and admin, those numbers are the same as the T12. Fickling is able to bring our general and admin down. That should hover around closer to about $8,000 a year, but we're leaving that little bit of cushion in there just to be hyper conservative. Insurance, you can see our insurance is going to go up, and that is because of the aluminum wiring remediation. Insurance is going to go up even higher for the first 3 months while we're doing the remediation. Once we complete that pigtail project, it's going to allow that insurance to come down to right around $500 per unit per year. That is built in that $72,000 insurance. Legal, we're keeping that in line with the T12. If you look at their T12, the majority of their legal expenses were from the months closer to the beginning of the T12. And part of that is they were evicting bad tenants. The current tenant base, as you see through the current 3% bad debt, is paying, and they're paying in a timely fashion. So evictions are remaining low. So that should actually, legal burden should come down, but we're keeping it in line with the current T12 just to be conservative. Taxes will stay the same in year 1. They will go up in year 2 based on the purchase price. South Carolina has what's called ATI, which is going to, it's basically a way to ease the transition into the higher taxation. That's going to be at 75% of the assessed value in year 2. And you can see we've modeled that. Taxes will go up from about $65,000 a year to $124,000. And then the full tax burden will hit in year 3 at $166,000. All of those numbers were confirmed with the tax assessor's office. So our taxes will go up, but that is built into the underwriting. Next, trash removal. This is a very high number for on-site trash removal. And the primary reason is the way that the trash is being run currently. So we have more roll-offs than we need because we are using those when we're turning units, or the current ownership group is using those same roll-offs that the tenants put their trash in. They're using for the materials from trashing out units when they're doing renovations. We will continue to do that. We do expect the trash burden to stay high in that first year and a half. We've kept it at a high level through the full 3 years, but we expect that actually to come down in years 2 and years 3 as we kind of complete a lot more of the renovations and get those out of the way. We should not need to have the trash picked up as often, and we will not need to have as many roll-offs. So we expect those numbers to come down, but again, in the nature of conservative underwriting, we're keeping those high. Management fee. So the management fee will go up from what the current management group is paying. The current ownership group is using on-site management, their own on-site management team. So they own their own management company. Fickling is a little bit more expensive than what that in-house management is, but they're worth every penny. So it's a 4%, as you can see, 4% management fee, and then payroll burden of $130,000. That $130,000 is for a full-time leasing agent, or excuse me, a full-time on-site manager and a full-time on-site maintenance supervisor, and then part-time maintenance tech and part-time leasing agent. We are going to be keeping the current staff on. We were extremely impressed by them. They'd like to stay on with us. So we're going to keep them on. And this is we've actually built in a little bit of a cushion because we think that the maintenance tech deserves a little bit of a pay raise. He does a great job. We want to keep him happy. And so that's why we've built in a little bit higher payroll than what's currently in the T12. R&M. We are bumping up the R&M from the current group had it modeled out at around $420 per unit. We're bumping that up to $500 per unit. We don't expect it to be that high. Once we go in and renovate the additional 80 units, those are the units that are causing the most maintenance problems. And it's because they haven't been renovated in 15 years. So we're going to go in, we're going to renovate those units. That should help bring our R&M budget down. But again, as you guys know, we like to budget around $500 a door. If you look at the rest of our portfolio where we budget around $500 a door, we are well under our R&M budget at every single property that we've budgeted at $500 a door. We don't expect this to be any different. Water and sewer, we're keeping right in line with the current T12 numbers. And then last but not least, our replacement reserves, we are going to put $250 to the side per unit per year for unexpected things that may come up. The good news is a lot of times those costs go to things like future roofing, future HVAC replacement, but the roofs are less than 5 years old and 80% of the HVACs have been replaced within the last 5 years as well. So we think we're really building in a very nice cushion for any unforeseen things that may come our way. In addition to that, we do have $1,000 per door that we're putting into reserves on the front end to build out that cushion. For those of you that have looked at other deals, a lot of folks will put $500 to $700 in that reserves account. We like to put $1,000 per door in that cash reserves account to really be able to handle anything that comes our way that may be unforeseen. We'd rather be in a strong cash position than be caught with something unexpected and feel like we're not in a good place to handle that. So with those strong cash reserves, we can really handle anything that comes our way. You can see current NOI in the T12, current expenses were around $562,000. That will go up about $60,000 in year one. We're looking at an NOI of just under $510,000 in year one. That'll jump up about 60 grand in year two and jump up closer to $100,000 in year three. Part of that is tightening up our expenses. The other part of that is really pushing those rent bumps. We expect to be able to achieve those 3-year rent bumps closer to the 24-month mark. But again, just in the nature of conservative underwriting, we're building that 80-unit renovation and the remaining rent bumps over a 3-year period, as opposed to the 24 months that we think we'll actually be able to do it. We do have a 2% asset management fee. This is a 75-25 LPGP split. And then that brings us back to the returns, a 17.4% average annual return, 16.1% IRR, and a 1.53 equity multiplier. So what does that mean in actual cash numbers? If you invest $100,000 in this deal, the projected returns should be right around $152,000. You'll get your original $100,000 back, plus an additional $52,000 in 3 years. We will be doing a cost segregation study for this property, which will create depreciation, the opportunity for pass-through depreciation for our investor base, just like we do with every other property that we have. This will be a quarterly distribution paid out to investors. Distributions will start at the 6-month mark. That's about the amount of time that it takes us to really get in, take over the property, feel really confident with our understanding of the property, and start pushing those rents. So we like to do our first distributions around the 6-month mark. Just to put our conservative underwriting in perspective, with 3 properties ago was that Regency property, that 82 units in Clemson that I showed you the signage from prior. Our 1-year rent project, or excuse me, our 1-year conservative underwriting showed flat returns in year one. We were not going to pay out any investor returns in year one. And because we underwrote it so conservatively, we were able to keep our expenses so dialed in and keep our expenses so low. We're actually able to pay out $50,000 in investor returns and quarterly distributions in the first 6 months. We were projecting 0 for the first 12 months. We paid out $50,000 in the first 6 months. So again, that's just a testament to the conservative underwriting and the ability to outperform our pro formas. This is just breaking down kind of the annualized cash on cash. We're looking at with that 15% vacancy, both economic and physical combined, we're looking at a 5.8% cash on cash return year one. It jumps up to a 7% cash on cash year two. Year three, that does drop back down but that's a product of our interest only period coming to an end, as well as the full tax burden kicking in that third year. But again, that's still at a 10% vacancy, which we're currently operating in both physical and economic combined at 5%. So I think there's a lot of cushion there to outperform these pro forma numbers. As I mentioned earlier, the investment structure, 75% to the limited partners, 25% to the GP. The GP is intending to put around $500,000 into this opportunity, which is about a sixth, it's hard to say. But that turns out to be about 16% of the investment will be coming from the GP team. We've talked about the total returns. We are looking to hold this much shorter than our traditional investments. The primary reason for that is it's not a heavy lift. We can get in, finish the renovations, do the minimum exterior renovations, add in the playground, and start pushing those rents immediately. We think we can get in and get out within 3 years and have a really strong returns for our investor and give you back your capital with your returns to be able to redeploy in the next project. That's the goal to wealth building. Get you your money back and leverage that compound interest mentality and let you redeploy it in the next investment opportunity. We could certainly hold your money for a prolonged period of time, but all that's going to do is drive down the IRR. We'd much rather give you the full 1.53 equity multiplier backing in so that you can redeploy it and take advantage of the growth on that new investment amount. Minimum investment's $50,000. Maximum investment, again, is $600,000. The webinar is obviously tonight. We are going to open this up to funding starting on Friday at noon. And Brian's going to speak to that. And I'll go ahead and actually pass it over to Brian Mallon to talk to you guys a little bit about the timing and how to utilize and leverage the investor portal.
Yeah, so we will send out the recording of this webinar tomorrow morning to everybody. And then the plan is to open it to funding via the investor portal Friday by noon. So everyone should have seen at the link at the end of the investor packet to create your contact within the investor portal if you don't have one already. There's also a video there that just walks through the process of creating an entity or utilizing an existing entity that you've used before. So everything's laid out at the end of the packet. Any issues, you can just you can give me an email and or a call, and we'll get you set up. But again, everyone will see the recording tomorrow, and then we'll open it up to funding via the investor portal by Friday. So you'll get a notification via email that you have a new offering available through your investor portal.
Yeah, and guys, you know, I just want to, if you're interested in this opportunity, if you have questions, please reach out to us. Our last investment did fill up in about 48 hours. This is our largest webinar to date. We had just around 200 people that RSVP to the webinar. Not all of them could attend, certainly live, but those were people that if they couldn't attend live, wanted a recorded copy of the webinar. So we expect for this one to fill up certainly by the end of next week. So if you like what you see, if you have questions, if you want any clarification around anything, please ask, but we fully expect this to fill up very quickly. And at this point in time, I'm going to open it up to questions.
So I'll run through some of the chat questions that we got, and you guys feel free to jump in and either add additional chat questions, or you can just unmute yourself and ask a question. We've been getting a lot of questions about Eric's hair. So if you want to just address that real quick, he did not shave his head. It's actually pulled back. He had a whole Bob Ross look going. So
I'll show everybody just for the full transparency. So the hair is still here, but I'm in Charlotte. I was touring several properties today, and so I'm staying with a friend, and I don't have my green screen, and without the green screen, it makes my head look like a giant mushroom. So I pulled it back so that it would look a little bit cleaner, but the hair is now out. The shades are back on top. So I did not shave my hair.
All right. So I'll run through some of these chat questions real quick. So Vinay had a question about the remediation of the aluminum wiring and
Yes.
how we'll go about logistically dealing with that, and with having obviously tenants in place. The gist of it is, we'll have electricians come in, we'll give advance notice, we'll take care of all the remediation in one fell swoop. If you want to add anything to that.
Yeah, so we actually had multiple electricians out on site with us during due diligence to go ahead and take a look at the units. The company that we've decided to go with has a large crew. They can get in and do a unit, a complete unit in a day while the tenant is at work. So we will be, and some of the units have been remediated. A small percentage of them, about 5% of the units have already been remediated, but they are going to be able to do it with the current tenant base in place. They have a process, they've done it before. So we felt very confident when they broke it down to us on kind of a granular level of how they'll be able to do that. They gave us a full strategy and a plan. So we can do that. We do not have to wait for turns of the units to be able to remediate that wiring.
Brian Williams had a couple of good questions. I'll go one by one. You could address them. When you talk about occupancy, are you referring to economic occupancy? What is the current wage salary to rent ratio, and what do you forecast it to be once renovated?
Yes. So those are great questions. I do not, I'll be completely candid. I do not know the wage to
Salary.
rent, ratio. I can find that out for you, certainly. This is still a C-class property and it is a lower income demographic. It's not about, but so to come back to the occupancy, it's currently at 2% physical or 98% physical occupancy, 2% physical vacancy, roughly right around 3% bad debt. So that economic occupancy, it's at 97%. Of that 3% bad debt, I think I mentioned earlier, a little over 2%, about 2.2% of that is coming from 5 tenants, of which eviction has already been filed.
All right, next one. How do you expect to get year one rent bumps? Curb appeal, renovation, or combo? What's the
Combo.
expected number of renovated units per year?
Yep, great question. So the beautiful thing about being fully occupied, and I know we say 98%, but again, 2 units are down and uninhabitable. So of the units that we can actually lease out and have tenants live in, we're at 100% occupancy. When you have that kind of occupancy, you can really be aggressive with your renewals, because it gives you a little bit of cushion to allow the folks, well, 2 things here. One, it gives you a little bit of cushion to allow folks that don't want to pay that to get out and get the right tenant base in. And the second thing of that is, if you looked back when I showed the rent comps, this is the cheapest apartment in Florence currently as it stands. So if they want, needless to say, if they're living in the cheapest rents in Florence currently, they're probably not looking at home ownership, if I had to guess. And there is nowhere cheaper to go. So it gives us a tremendous amount of leverage to be able to push those rents. But we are going to do that through a combination of both interior and exterior renovations, as well as some strong marketing and aggressive rent renewals on renewals. Did that answer the question, Brian?
I'll let Brian Williams jump in if he wants. His next question was, any thoughts to washer and dryer hookups in the units?
Yes. So that opportunity exists. It really comes down to space. If you saw in when we broke down the unit kind of floor plans, they are all galley style kitchens. And if we were going to put a washer dryer in, it would have to be stackable, and it would go in kind of that pantry area and that's where the hot water heaters currently live. So it would be a tight squeeze. It's not that it's not doable. I just don't know that the juice would be worth the squeeze. Another thing that we're really looking at, because of the shorter hold window, is we don't need to do that to get the rent bumps that we're looking to command. If you look at the comparable properties, the comparable properties are already getting our 3-year rent growth numbers today, and they're doing that at 96% occupancy. So we do want to get in, do what we need to do, and get out in a very timely fashion and maximize the returns for you, the investors. But to do that, we also need to leave some meat on the bone for the next guy that wants to come in behind us when we exit. And that's a great way, 2 ways that we can do that. One is leave some of the windows, which will, if we replaced 100% of the windows, it would certainly cut down on the electric bills, which would allow us to push rents even further. But that's a massive CapEx undertaking. So that's something that we're going to leave for the next folks, as well as something like washer dryer hookups. That's really something that someone else can come in and leave some meat on the bone for them. That is not part of our business plan, but it's a great question. We just don't need to do it to hit our numbers.
That he had another question about real estate taxes staying the same year one, which you addressed.
Yes.
Renee had a question. What is the eviction landscape of tenant claims? Are they being affected by COVID?
They are not. So South Carolina really has not been grossly affected by COVID, and because it is a red state and it is a more conservative state, the judges as a whole have been very landlord friendly. Now, there are certain pockets of South Carolina where that is not the case. Some of the more blue sections, the Charlestons, for example, that has not necessarily been the case. But in some of the more rural areas, and Florence is no different, evictions have not been a challenge. We are able to basically file for eviction and have tenants out within about a 30-day time span. In addition to that, about 6 weeks ago, a federal judge in Texas overturned the eviction moratorium. And so there is going to be a lot of pressure coming in, and the eviction moratorium slated to end September 1st. So we have a lot of things working in our favor that will continue to allow that to not be an issue. But that has not been an issue at this property, and we don't expect it to be an issue moving forward.
All right, Dharmendra asked, what are the cap rates now in the market, and what is the projected cap rate at exit?
That's a great question. So the current cap rate in the market is about a 5.5, 5.6 cap. As you guys know, cap rates have continued to be compressed. There are two other projects that are C-Class 70s vintage product in a little bit better location that are under contract. One's under contract at they have not closed yet, but one is under contract at a 5.2 cap, and the other one's under contract at a 5.13 cap. So that bodes extremely well. We have this under contract at right at a 5.85 cap as it stands currently. We're adding 10 basis points per year of hold. And so we're looking to exit right around a 6.2 cap in 3 years.
Sammy is watching from a bullet train in China, and his question was, it's an early 70s property, any lead pipe or plumbing issues?
No, there haven't been any plumbing issues. We actually did have a plumber come out and take a look, and everything came through nicely. We are not, so when we talk about low flow, we are not going to be doing hiring a company to come in and completely revamp the plumbing, like you would with like a Fannie Green loan, where they come in and put the Niagara 0.8 gallon per flush toilets. We are not doing that. We are going to be putting in low flow toilets and sinks, but they are not the ultra high efficiency low flow. So those take up much less of a toll on, much less of a burden on the 70s vintage plumbing. But no, the plumbing's in good shape. When we looked at the maintenance requests, believe it or not, the number one consistent maintenance request throughout the entire property was the bifold closet doors falling out of the tracks. So that is something we're actually looking to address. But plumbing was very low down the list when it came to maintenance requests.
All right, Sumanth asks, what is the annual cash on cash?
The annualized cash on cash, we're looking at 5.7% year one, or 5.8% year one, 7.7 year two, and then it does drop down to 5% in year three. But keep in mind, all of these numbers are predicated on the hyper conservative underwriting, right? So we have 15% vacancy between physical and economic built in for year one, and the property is currently performing at 5% physical and economic vacancy. If we can maintain around that same level, those numbers are going to be significantly higher. This is what's projected in a very conservative underwriting, very conservative pro forma.
All right, Dave asks, is there any cushion built into the CapEx budget compared to the full rental cost?
Yeah, so an article actually came out today that talked about we're talking about CapEx, excuse me. There is a cushion built in. We have about a $50,000 cushion built into the CapEx budget. In addition to that, we have about $144,000 of cash reserves sitting there as well. We do have, when we originally looked at the property, we built in to replace 1,000 windows, which is $400,000. It's about $400 to replace and install new high energy windows. I don't think we're going to end up going down that path. I think we're going to replace about half the windows in the property, which is going to be closer to $200,000, which will give us an additional $200,000 cushion. The beautiful thing about the CapEx budget is we want to build in a big enough cushion that if we want to further, if we see the benefit in rents by not replacing windows, we can continue down that path. But worst case scenario, if we see we have a surplus of CapEx monies, we can return that to you, the investor, earlier on. We don't have to hold that throughout the full 3 years. So we have the luxury of being able to return some capital if needed, if we don't see that we're going to use that full CapEx budget. But all of these returns are based on using that full CapEx budget.
Did you want to mention that cap rate article?
Yeah, so there was a great article that came out on Globus this morning talking about the pressure to continue to compress cap rates. The primary reason for that is by the end of this year, there's going to be a 3.2 million unit housing shortage. The bulk of that being in the Southeast and Southwest. So there continues to be huge demand for housing. And as long as that remains, cap rates are going to continue to compress. So, everything, multifamily weathered COVID extremely well, and it just continues to drive cap rates down and drive prices up. So if you're out there underwriting deals regularly in strong markets with strong growth metrics, I couldn't tell you the last time I saw a true 6 cap. Everything is in the low to mid 5s. And if you get into certain strong, like really strong markets, like your Raleighs, your Greenvilles, your Charlottes, you're starting to see cap rates in the low 4s and mid 4s for 70s vintage C-class assets. It is crazy. So the fact that if this was a 6-year hold, I would say, yes, I would like to see cap rates in the mid 6s to be hyper conservative. But with cap rates continuing to go down, continuing to get more aggressive and pricing going higher and higher on a 3-year hold, I feel very, very confident in our ability to exit this property with our cap rate being very, very conservative in 3 years.
Emma asks, what's the break-even occupancy year over year? And is there a promo? If so, what is it?
No, so the break-even occupancy is in the mid to high 70s consistently throughout the product. And part of the reason for that is the occupancy. So it's even occupancy remains high, but we're looking at around a 76, 77% break-even occupancy. No promote.
And then Ed asks, how about a check on outside sewer piping?
Yep. So we did have a plumber that came in and was part of the due diligence. Everything came in clear and looked really strong. So we have no concerns about the plumbing. The wiring checked out exactly how we thought it was going to. We did know that there was aluminum wiring coming into this, and it was confirmed. So there were no surprises during due diligence. If anything, the surprises were the property was much cleaner than we anticipated with it being a 70s vintage property. The current ownership group has done a great job over the last 2 years with their renovations and their cleanup of the property, and it really showed.
PC is asking, is this a 1031 exchange compliant asset?
Yes.
Josh is asking, when we think about the average rents and improvements you plan, are you seeing a differential in average rent between the units already renovated versus the unrenovated units? What are those numbers, and how much of your planned 3-year improvement of approximately $150 per door is tied to renovation versus just pushing rents to market comparables?
Yes, so that's a lot to unpack there. And I'll do my best to answer all of it. I might need the question to be repeated. But the long and short is they are already starting to push rents more and more aggressively because of the level of occupancy. So that's one of the things that Kristen said. She feels that our rent bumps are very, very conservative, those $150. She thinks that in the current state, that Kristen is the VP of management at Fickling. She seems to feel that we can achieve very close to those 3-year rent bumps with very minimal capital improvements, just because of what the market is currently doing as far as rent comparables and what we're going to be able to do with the demand for this product and the occupancy as high as it is. It gives us a ton of leverage to be able to increase rents on renewals. That said, we're always going to underwrite conservatively. Do I think that our average annual rents are going to be at that 808 mark in 3 years? No, I think they're going to be closer to $850 in 3 years, to be quite honest. But we just want to err on the side of conservative, on the conservative side. Again, the fact that our 3-year rent bumps are already being achieved today from competitive properties speaks to the fact that we're going to be able to raise those rents and get that without much challenge. Did that answer all of those questions?
I think so. Josh, if that does not, let us know. Yes, it does. So that's all the questions we have. So we'll give it.
Oh, I see a couple more trickling in through the chat.
Here we go. PC, are all the comparative properties have outside laundry units?
Have outside laundry, like a laundry room?
I guess probably on-site laundry units.
Oh, I see what they're saying. No, so some of the comparable properties do have laundry inside. Some of them do rely exclusively on the laundry facility, like the communal laundry facility. So it is somewhat of a mixed bag. I can tell you that the properties that do have laundry units inside, not all of the units have them, and they are charging a higher premium for those with laundry versus the other. So the averages that are coming in are factored in with both.
I got it. And then Brian was asking if there is a soft commit. So the soft commit will be your commitment through the investor portal when it opens on Friday. After that, about a week or two later, we'll push out the PPM for everyone's review. You'll e-sign that on the investor portal. And then along with that, you'll have the wiring instructions. And then we'll look to have everything wired by, what was it, July 10th?
July 9th.
July 9th. Hema asks, can you talk about reserves? How many months of operational expenses are you guys retaining untouched?
That's a great question, Emma. So if we look at our expenses, we're with our reserves, we have, if we were to have 0% occupancy, we would have enough reserves in the bank to cover 3 months of operational expenses.
That is all the questions. So we'll give it about 60 seconds. If you guys want to unmute or type up another question. Otherwise, we'll wrap it up and let everyone get back to their evening. I'll put in my email in the chat if anyone has a direct question about the investor portal.
I see a few more questions have trickled into the chat, Malin.
No, it's a lot of thank yous.
Oh, okay. And guys, if anybody wants to connect one-on-one with questions, obviously shoot us an email. Feel free to text me. I believe everyone has my contact info. But we're really excited about this one. Again, at $55,000 a door, we feel like it's an absolute steal. So, you know, we literally underwrote about 600 deals in the past 6 months, or even more. We submitted 6 LOIs. We got outbid in the 11th hour in several of them. So we're really, really excited to be able to bring this one to market, to our investor base. I really think this is another diamond in the rough, and just keep doing, we're going to keep doing what Four Oaks Capital does and be very conservative with our underwriting and under promise and over deliver.
And we have Lieutenant Colonel Brian Briscoe on here as well. If anyone has a question for him and the Tribe of Titans education platform.
And that will be blasted out. We'll have some email information coming out from that in the next probably 30 days as well.
I will say very soon to be Lieutenant Colonel retired Brian Briscoe.
Yeah. There we go. Steve had a question. Are investments accepted by order of receipt or is priority given to investors in any manner?
That's a great question. You want to take it, Brian, or you want me to answer?
Fire away.
So it's first come, first serve. So we do have, oftentimes our previous investors will let us know if there are soft commits. And we do have multiple soft commits that have already occurred from folks that let us know prior, basically said the next opportunity that you have, we want to invest in. So we do already have some soft commits from from folks that have invested in previous endeavors. But it will be filled in a first come, first served manner. And the waiting list will be filled in that capacity as well.
That is it.
Well, Four Oaks family, thank you guys so much for joining us. We apologize again for the technical difficulties last week. So for those of you that made it back, thank you so much. We appreciate your trust in Four Oaks. We look forward to working with you. And if you have any questions, please don't hesitate to let us know.